Guys, Dennis Tubbergen here with an economic video update. Today is Monday, March the 19th, 2018. You know, there's an old saying that says the more things change, the more they stay the same. And that's certainly true. I have on the screen in front of you a quote from Irving Fisher, who had a PhD in economics from Yale. And back in 1929, in October, just before the market crashed, he said, stocks have reached what looks like a permanently high plateau. I want to share with you an article that was published on Zero Hedge at the end of January. And it's written by Tyler Durden, or actually Lance Robertson, Tyler Durden. And it starts out by saying there seems to be a very large consensus the markets have entered into a permanently high plateau, or an era in which price corrections and asset prices have been effectively eliminated through fiscal and monetary policy. That alone should be a huge red flag. If you take a look at what's happened since the financial crisis, this chart, the first chart in the article, talks about total debt in the system. It actually says total system leverage. That's government debt, corporate debt, household debt, margin debt, and bank debt. And you can see that debt is significantly higher today, this red line here, than it was at the time of the financial crisis. So most of this recovery has really not been a recovery at all. It's simply more debt-fueled consumption. The article continues, yes, current economic growth is good, but not great. Inflation and interest rates currently remain low, which creates an environment in which using debt remains opportunistic. But rising debt levels has a negative economic consequence. Why? The bill has to be paid. In fact, if you take a look at this next chart, it says, as shown, prior to the deregulation of the financial industry under Ronald Reagan, this chart goes back to the mid-60s, it required just $1.25 of total system-wide debt to create $1 of economic growth. Think about it. $1.25 in debt to get $1's worth of growth is a terrible deal. That's reverse leverage. That means debt is rising faster than economic growth. That is a recipe for catastrophe. Today, however, this is shocking. It requires $3.83 to create the same $1 of economic growth. It takes 3 times the investment to get the same dollar. Now, if I were to tell you, you give me $3.75 and I'll give you $1, you'd say that's a terrible deal. However, that's what's going on. If you take a look at all this debt that we've accumulated, collectively speaking, again, this red line is government, corporate, household, margin, and bank debt. For every $3.83 in debt that we've accumulated, we're only getting $1 in economic growth. So it's going to be harder and harder to pay this off. We're digging a very deep hole for ourselves, and that's why we're extremely concerned and bearish on where the economy and where the markets might go. Now, if you take a look, one more point here in the article, quantitative easing or money printing. Quantitative easing programs are the central bank's emergency measures for supporting the financial system during crisis events. Then why are central banks still engaged in these programs nearly a decade later? It's because whenever money is printed to solve a financial problem, whether it's Weimar Germany or Zimbabwe or John Law's France in the early 1700s, and there are literally dozens and dozens and dozens of historical examples, money printing is always thrown out there as a temporary measure, and we're only going to print money until this happens. We're only going to print money until we grow our way out of the economic problem. And inevitably, it ends up being a permanent solution that leads to ugly economic consequences. That's where we are today. Today is Monday, March 19th, 2018. I'm Dennis Tubbergen, and that's your video economic update.